Feeling overwhelmed by the constant ups and downs of the stock market? Do you want to start investing, but the fear of buying at the wrong time is holding you back? If these feelings sound familiar, rest assured that you're not alone. Navigating the volatility of the markets can be daunting, especially for new or inexperienced investors. But what if I told you there's a powerful investment strategy that can help you overcome these challenges and reach your long-term financial goals? In this video, we're going to explore a time-tested approach called dollar cost averaging, DCA. This simple, yet highly effective investment technique can be a game-changer for investors of all experience levels. By investing a fixed amount of money at regular intervals, regardless of the asset price, DCA can help you smooth out the market's roller coaster rides and take the emotion out of your investment decisions. No more second-guessing yourself or trying to time the market. With DCA, you can take a more disciplined and consistent approach to building your wealth over time. Whether you're just starting your investment journey or looking to fine-tune your portfolio, the principles of dollar cost averaging can provide you with a solid foundation for long-term success. So, let's dive in and learn how this powerful strategy can work for you and your financial goals. Dollar cost averaging is the practice of investing a fixed amount of money into a particular asset or investment at regular intervals, such as weekly, monthly, or quarterly. The core principle behind DCA is to buy more shares when the price is low and fewer shares when the price is high, ultimately averaging out the cost per share over time. To illustrate this concept more vividly, imagine you're out grocery shopping and you decide to buy a certain item every week, regardless of the price. Some weeks, the item might be on sale, so you can load up your cart and buy more of it. Other weeks, the price might be higher, so you'll purchase a smaller quantity. By the end of the month, you've averaged out the cost per item, ensuring you don't overpay during any single trip to the store. This same principle applies seamlessly to the world of investing. By consistently investing a fixed amount, say $500 per month, into a particular stock, ETF, or mutual fund, you're able to take advantage of market fluctuations. When the price is lower, your fixed investment buys more shares. When the price is higher, it buys fewer shares. Over time, this consistent approach helps to lower your average cost per share, effectively smoothing out the market's ups and downs. The beauty of this strategy lies in its simplicity and discipline. Rather than trying to time the market and guess when the right time to invest is, dollar cost averaging removes the guesswork and emotion from the equation. By sticking to a predetermined investment schedule, you can focus on the long-term growth of your portfolio, rather than getting caught up in the short-term volatility that can often paralyze investors. Whether you're new to investing or a seasoned market participant, the power of dollar cost averaging can be a game changer. By leveraging this proven technique, you can build wealth systematically, taking advantage of market fluctuations and minimizing the impact of emotional decision-making. It's a strategy that can benefit investors of all experience levels and risk profiles, making it a versatile tool in the pursuit of long-term financial success. One of the primary benefits of dollar cost averaging is that it helps reduce the impact of emotional investing. When the market is volatile, it's easy to get caught up in the fear of buying at the wrong time or the temptation to time the market. DCA removes this emotional element by taking the guesswork out of when to invest. Additionally, DCA lowers investment risk by averaging out the cost per share. Instead of investing a lump sum and potentially buying at the market's peak, DCA ensures you're buying shares at different price points, effectively mitigating the risk of buying at the wrong time. Another significant advantage of DCA is that it instills discipline and consistency in your investment approach. By automating your investments at regular intervals, you're less likely to make impulsive decisions based on market fluctuations, which can often lead to suboptimal outcomes. Importantly, DCA is suitable for all market conditions, whether the market is in a bull or bear phase. This makes it an accessible strategy for investors of all experience levels, as it allows for investing with smaller amounts on a regular basis. Let's consider a real-world example to see how dollar cost averaging works in practice. Imagine you decide to invest $500 per month into a broad-based exchange-traded fund, ETF, that tracks the S&P 500 index. Over the course of a year, the price of the ETF fluctuates, with some months seeing a higher price and others a lower price. By consistently investing $500 each month, you end up buying more shares when the price is lower and fewer shares when the price is higher. This results in an average cost per share that is lower than if you had invested the full $6,000, 12x $500, in a lump sum at the beginning of the year. While dollar-cost averaging is a powerful investment strategy, it's important to acknowledge that it's not the only way to invest. Another common approach is lump sum investing, where you invest a large amount of money all at once. Lump sum investing can be advantageous in certain situations, such as when you have a windfall or inheritance. However, DCA often outperforms lump sum investing in terms of mitigating risk and managing emotions, as it helps investors avoid the temptation to time the market. Starting a dollar-cost averaging strategy is relatively straightforward. First, you'll need to choose the investment you want to focus on, whether it's an individual stock, an ETF, or a mutual fund. Next, determine the amount you want to invest and the frequency, weekly, monthly, quarterly, etc. Many brokerage platforms and investment apps offer the ability to set up an automated investment plan, making the process even easier. The key is to stick to your plan and remain consistent. DCA is a long-term strategy, so it's important to stay the course and avoid making changes based on short-term market fluctuations. It's important to note that dollar-cost averaging doesn't guarantee profits. Like any investment strategy, there are no certainties when it comes to the market. DCA can help manage risk, but it doesn't eliminate it entirely. Additionally, there is an opportunity cost to consider with DCA. If the market experiences a sustained upward trend, investing a lump sum at the beginning could potentially result in higher returns than a DCA approach. However, this scenario is difficult to predict, and DCA remains a prudent strategy for long-term investors looking to minimize risk and volatility. In conclusion, dollar-cost averaging is a powerful investment strategy that can help you navigate the market's volatility and achieve your long-term financial goals. By investing a fixed amount at regular intervals, DCA takes the emotion out of your investment decisions and helps you average out the cost per share over time. This systematic approach to investing can be a game changer for investors of all experience levels. Whether you're a seasoned market participant or just starting your investment journey, DCA offers numerous benefits that can help you build wealth with greater confidence and control. By leveraging the principles of dollar-cost averaging, you can reduce your exposure to investment risk, as your consistent purchases smooth out the impact of market fluctuations. This disciplined investing method also helps you avoid the temptation of trying to time the market, which can often lead to suboptimal decisions and missed opportunities. Importantly, DCA is accessible to a wide range of investors, from those just starting to save and invest, to more experienced individuals looking to fine-tune their portfolio management strategies. The ability to invest fixed amounts regularly, whether it's weekly, monthly, or quarterly, makes this approach scalable and inclusive, empowering investors of all backgrounds to take charge of their financial futures. As you continue on your investment journey, I encourage you to seriously consider incorporating dollar-cost averaging into your overall strategy. By doing so, you'll be well on your way to conquering the ups and downs of the market and taking the necessary steps to achieve your long-term financial goals. Remember, investing is a marathon, not a sprint. By embracing the principles of DCA and maintaining a disciplined, consistent approach, you can navigate the market's volatility with greater confidence and ultimately build the wealth you need to secure your financial well-being. So, what are you waiting for? Start exploring DCA today and take the first step towards a more prosperous tomorrow. So, what are you waiting for? Start exploring DCA today and take the first step towards a more confident and successful investment journey. Don't forget to check out the resources in the description below for more information on this exciting strategy. Happy investing!